welcome back to the another video today. So today, the first and foremost in any financial modeling, we build the forecast based on the assumptions. Now, in the given situation, they have already given certain assumptions. Based on that, we build the forecasted income statement or assumption based income statement. Now here, based on the historical data, they have assumed that this will be the forecast in the next 4 years. So due to which there is an increase in the subscription from the customers. Let's say Netflix or any Unacademy or Physics Wala online courses or NISM courses. So if you see, the revenue per customer is constant. However, the subscription is increasing. Or let's say any Netflix or Amazon Prime subscriptions. The subscribers are increasing year on year, irrespective of the prices. Here, the prices are constant, but subscribers are increasing. So, to what extent the subscribers are increasing, and to what extent due to which the revenue is increasing, and what shall be my operating profits and what shall be my net profits. So, such analysis we do it in the assumption-based income statement model. So here what we do is, firstly we merge this, bold it, we'll select the whole data first, cut this, and paste it below. Now, based on this information, we build the income statement. So firstly we'll analyze everything. So they have given the life of asset, capital expenditure, what is the debt outstanding, what is the rate of interest, the tax rates, then operating expenses, what is the revenue and what is the cost of goods sold assets. Now based on this, we have to build the forecasted model. So what we do is, we'll copy this and paste it above. Here above this, we'll merge it and give the header assumptions based income statement. See, normally the assumptions shall be in blue color. Why? Because it is the metrics or the multiples or the ratios that we have derived based on the historical information. Okay, so let me fill it with some color. Assumptions are built here. Now based on this assumptions, we'll build the income statement. Initially they have given the number of customers and revenue per customer. So calculate the revenue equals new customers into revenue per customer. Then less refunds. Refunds is nothing but the sales returns or the credit notes that has been generated based on the revenue. So here the refunds are 5% of the revenue, and there is a discounts given to the customers. It can be the trade discount or the cash discount. Here we'll assume that it is a trade discount and not the cash discount. Cash discount will be happening only when customers are paying in advance based on the goods delivered, whereas the trade discount is already mentioned in the original invoice. So we'll presume this as a trade discount at the time of sale. So out of the total revenue generated, there is a returns of up to 5%. So select the above revenue, lock it 2 times into why we are freezing is here the row will remain constant for all the 4 years. However, the columns are changing. So due to which I'm freezing the row and not the column. So use the function key F4 on your keyboard to lock it or to add the dollar sign in between. So function key F4 2 times so that the dollar sign will be added into, use the minus sign and select the refund percentage, then less discounts, select the above revenue into, use the minus sign, again discount is an expenses to the business, so we are adjusting it, use the minus sign and select the discount percentage. So here again log the revenue 2 times. So what you do is then calculate the net revenue, apply the sum total, select all the 4 columns, copy and paste it, then bold the net revenue, apply the top border, then leave a line space as cost of goods sold given in the assumptions. What they are saying is it shall be 45%, which means 45% of the revenue generated. That is the gross revenue and not the net revenue. The gross revenue that we have derived based on the unit sold and price per unit, 30 lakhs. That shall be the gross revenue. So you change this to gross revenue. So calculate the cost of goods sold, gross revenue into, use the minus sign, select the cost of goods sold percentage, then calculate the gross profits. Gross profit is nothing but the profit generated after adjusting the direct expenses, direct material and the direct labors. Okay, sum of all that we call that as a cost of goods sold. The formula for the cost of goods sold is opening stock plus purchases minus closing stock, and there shall be included the direct expense and the direct labor. So calculate the gross profits, net revenue, use the plus sign since the cost of goods sold is a negative, so use the plus sign, copy and paste this, bold the gross profits, apply the top border, then calculate the gross profit margin, since the gross profit is derived based on the revenue generated, again the gross profit margin shall be calculated based on the gross profit. So calculate the margin equals, select the above gross profits divided by net revenue. So this will be the gross profit margin. Here in the given case it is showing 0, that is because it is not converted into percentage, so change it to percentage, copy and paste it, then leave a line space, have the header as operating expenses. So in the given scenario, based on the assumptions, there are certain operating expenses like administration, marketing and other expenses. Select all the expenses, apply the pay special value. Shortcut key to apply the pay special value is Alt+V or Control Alt+V. Select the values. So the moment when you press Alt+S, the window will be popped up. Based on this, select the values. Now here again, this shall be calculated based on the gross revenue. Since we are building the forecast, assumption based, everything shall be based on the revenue. So calculate administration. So equals, select the gross revenue above, lock it 2 times, into, select the administration expense percentage, copy and paste it. So this way, calculate the total expenses, calculate the total OPEX, bold it, apply the sum formula to calculate the total OPEX. Now based on this, calculate the EBITDA value, calculate the EBITDA value, calculate the EBITDA value, bold it, gross profits plus total OPEX, bold it, copy and paste it, then calculate the EBITDA margin, calculate the EBITDA margin, EBITDA value divided by net revenue. So again, this is in the numerical value, so change it to percentage. So the operating expenses, everything is in positive. What I'll do is I'll add the negative sign here and copy this and paste it. Now if you see, the EBITDA margin is 8%. EBITDA margin is 8%. Bold it. Then we have the interest and depreciation to be. So we are left with depreciation and interest. Let's calculate the, firstly we'll calculate the depreciation and amortization, then calculate the EBIT value, bold it by the top order. So EBIT, EBITDA value, adjust depreciation, copy and paste it. Since the expenditures are shown in the negative, so we are using the plus sign while calculating the values. Then calculate the EBIT margin, equals EBIT value divided by net revenue. This is the numerical value. Change it to percentage. It is identical because the depreciation is not linked yet. Okay, then interest, calculate the EBT value. EBT value shall be EBIT and the interest, and paste it, bold it, apply the top border. Then taxes, they have given the percentage, so only when there is a profit you need to calculate the taxes, otherwise they need not to pay any taxes. Apply the if condition, EBIT value greater than 0, value if it is true, into, use the minus sign and select the tax rate, comma, value if it is false, let that be 0, close the parenthesis, then calculate the EAT, that is net profit. EBT value and the taxes. Copy and paste it. Apply the top border, then EAT margin equals EAT value divided by net revenue. So again it is in the numerical value, change it to percentage, copy and paste it, hold it. So this way we have built it. Now only left with the interest and depreciation. So under the assumptions they are given the debt outstanding and what is the interest rate. Now based on this calculate the interest payments equals debt outstanding above into the interest rate. So change this will be year on year the interest value, copy and paste it. Now here in the above assumptions I link it while using the minus sign, link the value using the minus sign. So this will be negative. Again interest is a expenses, cash is going out of the business. So here calculate the interest equals, select the interest, copy and paste it, copy and paste it. So the moment when I link the interest values, all the net profit margins are changing. Now we are left with the depreciation value. So what I'll do is we'll calculate the depreciation value. So here they have given the capital expenditure value as well as the life of assets. Now based on this we'll calculate the depreciation year on year. So capital expenditure. Now if you see here the furniture. So furniture only on the first year there is a addition and remaining years there is no new additional purchases. So this means, so based on the assets purchased in the year 1 has been used for the remaining years. So there is no requirement of new additions. So in such cases the depreciation value will remain same. So calculate the depreciation value, furniture's value divided by the life of asset shall be the depreciation value. So then this will be constant throughout for the next 4 years. So this is a straight line method. Under the straight line method the depreciation value shall be constant. I freeze the cell and copy and paste it. Then the machinery, there is an addition year on year. However, end of the 4th year there is no addition. End of the 4th year for all the assets there is no new additions. Then vehicle. So we'll do the vehicle first and then we'll jump into machinery. For vehicles, the first 2 years it is 0. The first 2 years it is 0. The 3rd year there is a new addition. I'll select the value divided by the life of asset. So this will be the depreciation value. So this depreciation value will be constant for the next 6 years. So here we are providing the depreciation for the first 2 years. So what I'll do is done. Now we'll calculate the machinery. Machinery, every year there is a new addition. Every year there is a new addition. So what I'll do is, so the first year depreciation value on the machinery. So the life of asset is 3. So on the 2nd year onwards, I need to provide the depreciation on the existing machinery as well as the new machinery. So the depreciation has to be calculated twice. Since we are following the straight line method, depreciation amount won't change. So we'll presume this remain constant. I'll select the year 1 depreciation plus I need to provide the additional depreciation for the new assets purchased during the year. Start with the parenthesis, select the asset value divided by the life of asset. So this way I'll be calculating both the year depreciation. So I'll be providing the depreciation for the existing assets as well as the current additions. Now same way, if you see on the year 3 as well, there is a depreciation. Now understand one thing, if this particular depreciation is not provided for the existing asset, so the depreciation value shall be only 33,000. Since depreciation is provided on the existing as well as the new asset, the depreciation value is 50k. Same way, when I provide the depreciation for the year 3, depreciation has to be provided for all the assets. That is, for the first 2 years of the assets which is purchased in the year 1 and year 2, as well as the current year new addition. So we'll presume this. The second year depreciation value will remain constant for the first 2 years of the assets, plus we'll calculate the depreciation for the third year additions. Select the third year additional value divided by the life of asset for the machinery. Now coming to the fourth year, the life of asset itself is 3 years. Now we are calculating the depreciation for the fourth year, which means year 1 additions shall be nullified by end of third year. So whatever the depreciation we are providing year on year, that is 16,667, is total sum to 50,000, which means end of fourth year or end of third year, the machinery value for the year 1 that we have purchased shall be 0. So which means in the given case, I need not to provide any depreciation for the year 1 assets. On the year 4, I need to provide the depreciation only on the year 2 and year 3 assets purchased. So what I'll do is, I'll select the depreciation value for the year 3 minus, I'll select the depreciation value for the year 1. So this way, the depreciation value will be 66,667. So I'll total this value. So this will be my year on year depreciation. So what I'll do is, I'll copy this, I'll paste it here. So this will be my total depreciation. I'll link this balance here in the depreciation column. I'll use the minus sign while linking the balance. I'll use the minus sign while linking the balance. Copy and paste it. Now come to this value here. Since it is not linked here, link the balances. You just have to use the equal, don't use the minus sign since it is in the assumptions already in the negative. So again, you need not to use the minus signs. If you use the minus sign, it will be added back. So use the minus sign, copy and paste it. So this way, if you see, the net profit margin is an increasing trend, 2345. EBIT margin is almost constant, 7% at 7%. EBITDA margin is also constant at 8%, and the gross profit margin is constant at 48%. So this way we build the assumptions based income statement. If you want to learn more about the financial modeling, like, share, subscribe, follow our videos and channel. Thank you.